Hey everyone, it's Robert Keens at goldsilverpros.com. It is Friday, November 13th, 2020. Hope you guys are gearing up for a fun and relaxing weekend. We're going to do a little bit of a gold and silver market report before we wrap up for the week and wish you all a very happy weekend. Hopefully you have some great activities planned. We're going to start by talking about gold. In fact, most of this presentation is going to be talking about gold and what's going on with it. We'll look at the gold price first. We're up today about 13 bucks to 1889.63. And up a little bit more in silver percentage-wise, 39 cents to 24.68. 24.50 is a key resistance point, so we've broken through resistance there. We'll see what happens with silver going forward. I wanted to start with the COT charts on bar chart here and discuss how short the swap dealers are on gold. In fact, I think that they're at an all-time short. They're at about, well, we'll get into the percentages here in a moment, but it's the green. This green line down here shows their short position, and the latest numbers as of Monday, November 9th, is negative 196,700 contracts of 100 ounce gold. That's about 200,000 contracts. That's quite a bit. And like I said, I think it's an all-time low, at least that I recall. So massive shorting by the bullion banks, also known as the swap dealers in the gold market. And I think that's holding the gold price down. We'll get to the details of that here in a moment. Because of Veterans Day, the CFTC says that the new COT report is not going to be out for the last week. So we have only the November 3rd report here, but we're going to look at gold. And as I said, as you look here, we got swap dealers short in this column. And as you see, they're negative 50.2%. So half of all shorts are by the bullion banks. And the next biggest short is going to be the producer merchants, which makes sense because they're shorting the price in the event that the price falls. The bullion banks is just massive paper shorting on the market, 50.2% as of November 3rd. Of course, we'll get the updated COT data on November 16th. And when we do, we'll talk about it next week. But it's the bullion banks pulling down the gold price as usual. And we're going to get to the gold chart. You see the smash that I covered in the last video. This massive, look at this massive shorting going on here that dropped the price down from the 1950 range all the way to about 1850. It's about a $90 price drop. Now it's kind of sideways traded the last 3 days as we ended up the week. They did their damage, so they didn't need to come back and do anything else to the market ending the week, and we'll see if it recovers next week. We're starting to have sort of a sideways trending, but a very schizophrenic market here. As you look at what's happening, I thought there was an opportunity for us to form a little handle here where the gold price would come down maybe to the $1,700 range or even lower and come back up. That'd be very bullish for the market. But every time we have a swing down, the longs come in and bid it up. So it's basically a battle going on here. And in fact, let's look at just like the last 6 or 7 months of what's going on in gold. We'll do 8 months here to see what we've got going on. Every time it comes down, the longs bid it back up through these key support levels. So there's a bit of a battle going on in the gold market. You have this massive amount of paper shorting, which I showed you a moment ago in the COT charts, but you have the longs coming in and bidding it up as well. So I think that gold price wants to go higher, and what they're having to do, in other words, is come with near record levels, as we see here on bar charts, near record levels of shorts to keep that gold price down. What that means is we really want to be in a gold bull market, and the market does overall. The financial types and the independent investors want it to be in a bull market, but the bullion banks are beating it down, trying to keep it down. How long they'll be able to keep it down, I really don't know. I don't expect they'll be able to do it forever. And we'll talk a little bit later in the presentation as to why the market wants to bid up the overall gold price. And we're going to look here at the gold volume. So latest numbers here, we had this big smash down here on November 9th, and then the volumes kind of faded toward the end of the week. Again, they had done their damage. And we'll look at the settlements as to why the gold price is rising a little bit today. You see on the December contract, 152,000 volume today at 1886, which drug the price up a little bit. And as we get further out into the next big trading month of February 2021, we had 17,000 closed contracts at 1893. So like I said, the market wants to bid it up after the big smash on November 9th that we saw from the bullion banks going basically record short. So this is the record shorting, and this is market coming back in, bidding it up through longs. And you see these massive shorts every once in a while as gold gets close to 2000. That seems to be a key amount for the powers that be that want to bring the price down. And, you know, the market comes back in and slowly bids it back up. And that's what we got going on. And silver, a little bit of a different story. It's basically been range trading here. I've got a short-term chart. Let's blow it out to a little bit longer as we review what's going on. Again, we've had a fair amount of trading here, but nothing like the big smash down. You see this volume here in the big smash down in silver the other day, along with gold, basically at the same time. We're now trading around this key 2450 line that we've been basically trading through. We went up through it a couple months ago when silver almost got to 30, and then we kind of down and then back through. And now you see all this range trading around 2450. I did call in July 2450 as probably being the most important support line here on this chart based upon past trading history. And it seems to be, we're all clustering around that area. And again, same thing, silver smash on November 9th, the longs come back in trying to bid it up, and we'll look at a shorter term chart of silver to see what's going on there. Had the big smash down and longs come back in to try to bid it up. You see a little bit more longs going than shorts, but again, another battle in silver. Long term, I think, given what we're seeing in the economy and especially the news I'm about to give you, I see it as being extremely bullish for gold and silver. And that's why the smash downs are having less and less of an effect. They only last for a day or two now before the longs come back in and bid up the market. Looking at the silver data, here is the date of the big smash, November 9th. And then again, a lot of longs coming in. Let's look at the settlements for silver. You see on the December 20th contract selling at 24.75. That's bidding the price up to tune of 55,000 contracts of 5,000 ounce silver. And again, out to March, one of the next big trading months for silver next year, 24,907. So there is a lot of incentive and a lot of sentiment in the market to bid up gold and silver. And the only thing keeping it down are these big smashes, the last one we saw on November 9th. Now on to the news. I want to talk to you about the reason why the market is trying to bid up gold and silver and why the bullion banks have to keep in and smashing it down with paper to keep it from breaking through gold all-time highs and silver breaking through that key $30 that we saw it basically touch on earlier this year. We have an announcement from CNBC that one of the Biden COVID advisors says U.S. lockdown of 4 to 6 weeks could control the pandemic and revive the economy. I think there's evidence from Sweden, for example, and other places that these lockdowns don't really do a lot of good. But in any case, that's what they want to do. And if Biden is eventually elected and confirmed to be elected through the constitutional process as the next president, and that is very much up for debate. So I want to recognize that. But if he does be confirmed as president, it looks like his advisors are telling him to lock down the economy. And that's one of the things that the Trump campaign was talking about during the political debate. So I think if any sort of lockdown does come to the economy, you're going to see numbers start to roll over. You're going to see more deflation. Of course, that would bid up both gold and silver. And that's why I think gold and silver are wanting to run right now. And I think that November 9th smash was to try to control the narrative in the actual gold and silver market so that as this news started coming out about impending lockdowns through the potential new next president of the US, gold and silver didn't reflect that and serve as a warning indicator in the economy for people. And I think that's basically what's going on. Here's an article from Reuters talking about gold gains on mounting pandemic vaccine worries. Again, as the pandemic, you know, if you want to call it a pandemic, worries increase, really what that translates to is economic worries because we're not having a lot of deaths as a percentage of the pandemic, but it's causing lockdowns, which is causing economic issues. And so it's economic issues which pushing gold and silver up. And from Reuters right here, they have it. Gold rose on Friday, and increasing coronavirus infections globally reignited concerns about the economic toll from the pandemic, while skepticism over the reach of potential COVID-19 vaccine further boosted the safe haven metal. Again, it's the impending shutdowns that are causing gold and silver to rise and why they needed to come smash it on November 9th, like they did both in gold and in silver. Have an article here from Zero Hedge showing that the global economy is already starting to roll over as the lockdowns return. It has some information about daily new cases and the reason and infections, the reason why they want to do it. But here's some interesting information. Here's Exhibit 1. Mobility plummeted across European nations with partial lockdowns. So as the European nations have been tighter with their lockdowns overall, the United States has been, with the exception of like maybe California, New York, and some other places. But overall, Europe has been tighter. And you can see the mobility start to roll down. And in the economy, which is generally not good. When you don't have mobility, you don't have trade of goods. And you also don't have trade of ideas in the service economy. And that could be that could be pretending another economic turn down. We also got national credit and debit card spending trends. So as you can see, credit transactions are going down. All spending has basically come down a little bit below this mean line of 0%. But overall, the credit card transactions are really coming down. And so that's a sign that people are spending less money. Of course, September industrial production is coming down here in India, and it's coming down in the Euro area as well. So that's a sign in two major economies that production is coming down. We've got restaurant bookings across Europe. We can see that they've plummeted. In Ireland, they've fallen precipitously. In Germany, we see in the U.S. that they restaurant bookings have fallen overall. So people have less discretionary money because of the turndowns in the economy, and they're spending less. Retail sales data is not very good. Department sales still are struggling. Mortgage applications have sharply turned down in the last month. Hotel occupancy has sharply turned down and never recovered since earlier this year before the lockdowns began. So they started to recover a little bit. And then as the potential impending lockdowns potentially return, people are booking less hotels. In anticipation of that, you got restrictions, push Google global GDP weighted retail and recreation activities down 21%, basically a measure of overall retail and recreation across the world. Europe was hit with travel issues. So you can see a lot of data here. Airbnb searches decline, people looking for less hotel bookings, travel related bookings in the economy. You're already seeing that start to come on, and you're seeing that in the media. So basically what that means is we're looking for more downturns, and I think people are coming to gold and silver as a result of that. Outside of the smashes, I continue to expect it to run because what's going to happen, we'll go back to the CFTC here. As the swap dealers are net short of 50.2% on gold, for example, eventually it's going to come back to bite them because if the price keeps running, they're eventually going to lose money in that trade. And it looks like some big entities now are getting into the precious metals. Here's an article from Reuters from today. Russia seeks to allow National Wealth Fund to invest in precious metals. Now, if you think back to what the Chinese are doing, they had their sovereign wealth fund invest in the metals, and really that should go on the central bank's balance sheet, but it's a way for them to keep it off the central bank's balance sheet, but still own it in China to kind of cover up how much gold they have. It looks like Russia is taking a page from that book and having their national wealth fund invest in precious metals. It says here, Russia's finance ministry has proposed allowing part of its national wealth fund to be invested in precious metals, according to draft legislation published on Friday. Finance Minister Antoine Siluanov has previously said he favored this plan, saying last year they saw gold as more sustainable long-term than financial market assets. In other words, gold's going to be better off than stocks, bonds, derivatives, and the usual claptrap that people try to get you to invest in. And that's why I'm trying to get you to invest in gold and silver, because I agree with that paragraph. The legislation itself proposes an amendment to an article in Russia's budget code on how the fund is managed, which would add precious metals to the list of financial assets it can invest in. The National Wealth Fund, which is designed to help balance the pension system and stores part of Russia's revenues from oil exports, is worth $167.6 billion, so on and so forth. So now we're starting to see some big players come back into the gold market. And this is the most interesting aspect of that is finance minister of Russia said he saw gold as more sustainable long-term than financial market assets. Of course, that's what I've been saying forever. And we also have something happening in silver here on silverseek.com. My friend Chris Marcus of Arcadia Economics was interviewing Andrew Maguire, and Andrew Maguire noted that there is one participant in the market buying all available, and I mean all available 1,000 ounce silver bars. Any large silver bar that can be bought in the market is being bought by one bank, and you'll have to watch the video. You can punch on this button here, and he will tell you right at the beginning of the interview which bank is buying all of that silver. That's a big thing that's going on, because buying all of it, one entity means they're storing it up. Why are they storing it up? What could be, their position on that? They expect the price of silver to rise, or their clients, very wealthy clients, could expect the price of silver to rise. So that's a big indication that, again, we're continuing into the silver bull market. And again, I don't want you guys to be worried about what's going on. Silver and gold are in the bull markets. It's these smash downs, these periodic smash downs that are keeping the price down. But the thing that you've got to focus on, it takes bigger and bigger smashes every time to keep that price down, because there's building global momentum for gold. And what happens is people buy the physical, and why I expect December to be a blowout month for physical deliveries in gold and silver, but they also come into the futures market to hedge and to speculate. And so that's what's going to drive it up. So how long are the bullion banks going to be able to hold these gold and silver massive takedown positions? I don't really know, in gold especially, because the amount of overall gold shorting by the bullion banks is historic. Not quite as much in silver, but I think they're going to get caught with their pants down as the price continues to rise. And there's certainly a lot to indicate that gold and silver are going to rise. We'll recap. I said leading up to this election was going to have a strong play when it happened to gold and silver. And I think all of the uncertainty around who's actually going to be elected is what's doing it. Of course, you have the impending lockdowns and the retort coming from the potential new President Biden and his administration on how they're going to lock down the economy. You saw the numbers from Zero Hedge in that study about how everything's turning down. So that's very bullish for gold and silver going forward. And our prediction was very true. The presidential election and the potential policy changes toward lockdowns really are going to have a major effect on that. And I also said that December was probably going to be a big month in the futures market for determining gold and silver going forward because we expect heavy deliveries. And again, I do expect heavy deliveries. We know, again, according to Andrew Maguire, that people are taking 1,000, one bank is taking 1,000 ounce silver bars off the market if he's to be believed. And I believe he is. He's a very reputable individual saying this, who's been in this market for a very long time. And we also see Russia National Wealth Fund getting into gold, and we start to see the longs battle the shorts. If you remember what I showed you in the charts, when we had those big smash downs, the longs come back in and bid it up. So the smash downs work temporarily. They're not working over the long term. They're real, and they're getting bigger. The amounts are getting bigger. So that means we're about to break. It means eventually those big smash downs aren't going to have much of an effect. And if we do get another set of lockdowns and that data I showed you from the Zero Hedge article continues to roll over, the credit card transactions, the retail, the restaurants, the travel industry, if those continue to roll over, that is like the canary in the coal mine for the rest of the economy, especially in the US, because we're a service-based economy. It's really going to affect the US and the amount of GDP that we generate, the amount of profits that we have. It's going to really tank the economy. We'll go back into another round of deflation in the economy. Of course, that's going to be bullish for both gold and silver. So again, what I've been saying basically this last half year about gold and silver and what I've been writing about for 10 years is now starting to come true. I think that the shorts are going to be overwhelmed. I think there's going to be a lot of physical delivery. So we'll see how that plays into gold going forward. But again, I see it as extremely bullish. And I think the data is very, very clear on that. I don't think there's a whole lot of argument at this point. So that's going to do it for me, guys. I hope you had a fantastic week. We had some really good content this week. Hope you guys enjoyed it. We will be back next week with even more good content. We'll continue to follow gold and silver. We may also have some updates on state-owned Fed coins. We'll see if we have an article on that as well. And of course, we're going to bring you some more mining company spotlight recommendations for those of you that invest in the mining companies in that end of the market. Until next time, this is Robert Keents with goldsilverpros.com.